On this slide, we're comparing real assets like real estate with traditional market assets, such as securities. Both offer paths to building wealth, but they come with different returns, risks, and trade offs. While the goal, growing your wealth, is the same, the vehicles you choose have unique characteristics. Real estate is a tangible property asset, whereas traditional investments typically involve financial securities. When we look at these options, we focus on key factors like return, risk, and liquidity. Understanding these differences is crucial as you decide which investment type aligns best with your financial goals and comfort level. When it comes to investor decisions, the choice of investment vehicle is crucial because it directly impacts your returns, the risks you face, and your overall flexibility. First, capital behaves differently depending on the path you take. Each option offers unique opportunities and challenges. Second, it's important to recognize that liquidity and control rarely happen together. You often have to prioritize one over the other. Lastly, choosing the wrong investment vehicle can slow down your wealth building process, which is why it's essential to compare your options carefully before committing. Understanding these key points will help you make smarter, more strategic decisions with your investments. When we talk about real estate as an asset type, it's important to recognize that it's a tangible, physical asset. This means you can actually see and inspect it, which is a big advantage compared to many other investments. Real estate generates value in a few key ways. First, it can produce rental income, providing a steady cash flow. Second, the property itself can appreciate over time, increasing its overall worth. As an owner, you also have the ability to actively manage and improve the property, which can further enhance its value and returns. This level of control is often higher than what you find in public markets like stocks or bonds. Essentially, owning real estate means you have an asset with physical presence, a direct influence on its performance, and potential for both income and long-term growth. When we talk about traditional portfolios, they're designed to spread exposure across market assets that are easy to buy, easy to sell, and simple to scale. Typically, these portfolios include three main types of assets. First, stocks, which represent ownership in companies. They offer higher growth potential, but also come with higher day-to-day volatility. Next, we have bonds, which are essentially loans to governments or firms. While bonds tend to provide a lower expected return compared to stocks, they often deliver steadier income, making them a more stable component of portfolio. Finally, mutual funds act as a single vehicle holding many different assets. They provide built-in diversification along with professional management, which helps to balance risk. A traditional portfolio combines these elements in a multi-asset structure that allows for low-friction access and fast reallocation, helping investors adjust their strategy efficiently as market conditions change. When we talk about returns in real estate, there are two main ways that a property can generate value for you. First, there's appreciation. This means the property itself increases in value over time. Appreciation happens for a few reasons. Market gains resulting from inflation, scarcity, or growing demand in the neighborhood, improvements you make through renovations or better management, which can increase the property's resale value, and the natural buildup of equity as you pay down your mortgage. The second key way real estate delivers returns is through cash flow. This is the income you receive while you still own the property, mainly from rent payments. After covering your mortgage, taxes, and operating expenses, positive cash flow provides recurring income that can boost your financial stability. This income not only supports your holding power, but also lessens the pressure to sell the property quickly. Together, appreciation and cash flow form a dual return stream. Appreciation builds your wealth in the long term as the property value climbs and equity grows. Meanwhile, cash flow supplies ongoing income that can be reinvested into property upgrades, reserves, or even future investments. In essence, your total return in real estate equals both the appreciation of the asset plus the net operating cash flow it generates. This combination makes real estate a powerful engine for building long-term wealth. When we look at traditional portfolio returns, it's important to understand that total return comes from two main components: dividends and price appreciation. On one side, we have dividends, which are cash income distributed regularly from company profits. These typically range between 1.5 to 4%, and tend to be steadier but smaller compared to capital gains. Dividends are usually paid quarterly or annually, and they offer income-focused investors a reliable stream of earnings that can be reinvested for growth. On the other side, we have capital gains, which represent the increase in portfolio's value as stocks and funds appreciate over time. This source of return typically falls between 4 to 8%. However, these gains are unrealized until the investments are sold. Capital gains play a key role in long-term compounding, making them a perfect fit for growth-focused investors looking to build wealth over time. Combining these two, cash yield from dividends plus price appreciation, gives us the total return of a traditional portfolio, which typically falls between 6 and 10% in the long run. Understanding the balance between these components helps investors align their portfolios with their financial goals, whether they're seeking steady income or growth. When we talk about leverage in real estate, the key idea is that you can control a large asset with a relatively small down payment. This is made possible through mortgage financing, which acts as a vehicle that allows investors to amplify their buying power. Using borrowed capital, a mortgage lets investors magnify both their potential gains and their potential losses. In other words, leverage increases your exposure to the asset, meaning you can own more property than you could if you were only using your own money. However, this increased exposure comes with a trade-off. While it can significantly boost your upside when property values go up, it also magnifies your downside risk if values decline. The essential differentiator here is debt financing. Unlike many traditional investment portfolios that typically don't use borrowed money at the time of purchase, real estate investors leverage mortgages to enhance their asset exposure and potential returns. But it's important to manage that risk carefully, as leverage cuts both ways. When we talk about liquidity, this is really where the gap becomes clear. Liquidity refers to how quickly you can convert an asset into cash. For example, if we look at Route A, which is real estate, it can take weeks or even months to sell a property and turn it into cash. The process involves listing the property, negotiating with buyers, and eventually closing the sale. Because of this lengthy process, real estate is considered to have low liquidity. On the other hand, Route B includes traditional investments like stocks, ETFs, or mutual funds. These can be liquidated within minutes, often just by placing an order, although the actual settlement happens a bit later. This quick turnaround means these assets have high liquidity. Understanding this difference is crucial because your access to cash can significantly change your investment strategy. High liquidity offers more flexibility and quicker access to funds, whereas low liquidity requires more careful planning and longer timelines before you can access your investment capital. When it comes to real estate investing, one of the biggest advantages lies in the tax benefits, which can significantly improve your overall returns. Unlike many paper assets, real estate can generate various deductions that help reduce your taxable income. First, depreciation is a key factor. This non-cash deduction lets you shelter part of your rental income by accounting for the wear and tear on the property over time. It's important because it lowers the amount of income you actually have to pay taxes on, even though the cash flow might remain the same. Next, mortgage interest is often deductible, which means the interest you pay on your loan can help reduce your taxable income. This financing write-off can make a substantial difference, especially in the early years of your mortgage when interest payments tend to be higher. Operating expenses such as repairs, insurance, and property management fees also count as deductible expenses. These costs are necessary to maintain and run the property, and writing them off further reduces your taxable income. Finally, when it's time to sell a primary residence, many jurisdictions allow for a capital gains exclusion. This means you may be able to exclude a portion of the profit from the sale from your taxable income, which can be a significant exit advantage. Keep in mind that tax rules vary widely depending on your location, so it's always wise to consult with a tax professional to understand how these benefits apply to your specific situation. These tax advantages can play a critical role in enhancing the profitability of real estate investments. When we talk about the risk profile of real estate, it's important to understand that these risks are physical, local, and often concentrated in a specific asset. Real estate risk is not spread out evenly. It's lumpy, meaning a single property can carry a significant portion of the overall exposure. Looking at the risk board, the asset in focus is direct property, which means we're dealing with actual physical buildings or land. The exposure is concentrated, so if something goes wrong, it can have a big impact. This is considered an operational risk, which means it comes from the day-to-day management and condition of property. There are three main categories of risk to keep in mind. First is market risk. Property prices can fall if local demand decreases, which affects the asset's value. Then there's vacancy risk. If there's no tenant, there's no rental income, directly hitting cash flow. Finally, maintenance risk is significant because repairs and upkeep needs can arise unexpectedly, sometimes requiring costly interventions. We've observed specific conditions like vacancy and deferred maintenance, which can further highlight vulnerabilities in managing the property. Understanding these risks helps us better manage and mitigate potential losses in real estate investments. When we look at traditional investments, it's important to understand their risk profile. These assets are typically liquid, which means they can be bought and sold quickly. But that liquidity also means their prices can move rapidly, often influenced by changing market sentiment, interest rates, and breaking news. One major risk is market volatility, which has a high severity. Prices can swing sharply, sometimes without warning, driven by investor emotions or external events. This can create sudden and significant changes in portfolio value. Next, we have sector risk. If your investments are heavily concentrated in one industry, a slowdown in that sector can drag down your entire portfolio. This risk is considered medium in severity, but it's critical to watch because it can undermine diversification efforts. Finally, economic sensitivity is another high-severity risk factor. Broader economic conditions like recessions, inflation, or shifts in monetary policy can impact multiple markets simultaneously. So even a diversified portfolio isn't completely immune to these larger economic forces. The key takeaway here is that diversification helps, but it doesn't eliminate risk entirely. Being aware of these specific threats allows us to manage portfolios more thoughtfully and respond proactively. When we talk about time, effort, and oversight in managing assets, it's important to recognize that different types of investments demand varying levels of involvement. For example, in real estate, which is part of a traditional portfolio, the management style is typically very active. This means hands-on tasks like maintaining tenant relations, overseeing maintenance, and handling repairs require regular attention and effort. On the other hand, some assets are mostly passive and need a different approach. Here, management focuses on periodic rebalancing and routine monitoring. These activities don't require daily involvement, but do need consistent review to ensure everything remains on track. The key difference is that while real estate management demands active engagement, other assets allow for a more set-and-review style of oversight, requiring patience rather than constant intervention. Understanding this helps in planning how much time and effort to allocate effectively. When we talk about capital requirements and entry barriers, it's important to understand how much cash you need up front to get started, depending on the type of investment. For real estate, there's usually a significant initial cash requirement. This includes a down payment and closing costs, which can range anywhere from $25,000 to over $100,000. Because of the substantial upfront cost, real estate is considered a high barrier to entry. On the other hand, traditional investment portfolios tend to have much lower entry thresholds. Opening a brokerage account often requires just a minimal initial deposit, sometimes as little as $100 or even less. This makes it much easier for people to get started with investing in the stock or bond markets. One key point to note is that real estate often demands cash up front before you can leverage or borrow against the property. In contrast, portfolios can begin on a smaller scale and grow over time through recurring contributions. So, while getting into property investment requires a bigger initial commitment, market-based investments offer a more accessible path, especially for those just starting out. The major takeaway here is that access tends to be much easier in financial markets than in real estate. Understanding these differences helps you choose the right investment approach that fits your current financial situation. When we look at the historical performance of real estate, one key takeaway is that appreciation tends to be steady, local, and compounding over longer holding periods. This means that real estate values generally increase consistently over time, which can build significant wealth when held for many years. Now, If we break down average annual appreciation by region across 10 20 and 30-year windows, we see some interesting trends. Nationally, the broad residential market has shown annual appreciation rates roughly between 4 to 5% across these time frames, emphasizing a solid, reliable growth pattern. Regions like the Sun Belt and higher growth metro areas tend to have higher annualized appreciation rates, often exceeding 5%, especially over 20 and 30-year periods. This reflects more dynamic economies and stronger demand pushing up property values. On the other hand, Midwest markets typically experience lower volatility and slower gains, with appreciation rates closer to 3.4 to 4% annually. Supply-constrained markets in coastal core regions often show slightly higher appreciation due to limited housing availability, reinforcing how local factors play a crucial role in real estate performance. The big picture here is that the power of compounding really matters in real estate. Holding on to property for the long term allows these steady gains to accumulate, which is why longer holding periods usually result in better returns overall. This steady growth, combined with local market dynamics, makes real estate a dependable investment over time. When we look at the historical performance of traditional investments like the S&P 500 and the Nasdaq, we see that higher long-term returns often come with increased volatility. Over multiple decades, the S&P 500 has averaged about a 10% annual return, while the Nasdaq has been slightly higher, around 13%. However, these returns are not delivered smoothly. Instead, investors experience sharp drawdowns and rapid swings in value, especially during market sell-offs where volatility spikes significantly. This means that while the compounded growth can be impressive over time, the journey includes periods of significant ups and downs that can test investors' patience and risk tolerance. Understanding this balance between growth and volatility is crucial when evaluating traditional investment options. Real estate investing really shines for those who can take a long-term approach. It's best suited for investors who are patient and ready to let their equity compound over time. This isn't a quick turnaround kind of investment. It's about holding on to the property and watching value grow steadily. High earners, in particular, can take advantage of the tax benefits, like depreciation and other sheltering strategies, to reduce their tax burden. But it's important to be hands-on. You need to be willing to actively manage the property, make improvements, arrange financing, and oversee the day-to-day operations. Ultimately, real estate works best when an investor fits a specific profile, someone who is engaged, committed, and aligned with the long-term horizon needed to make the most of this asset class. If that sounds like you, real estate can be a very compelling addition to your portfolio. On this slide, we're looking at when traditional investments are the best fit within your portfolio. Traditional investments work well primarily when convenience, flexibility, and low operational effort are your top priorities. This makes them ideal for passive investors who may not have the time or desire to actively manage their investments. Importantly, these investments are a good match if you have limited capital to deploy, but still want efficient portfolio diversification. They also make sense if you need liquidity, meaning you want the ability to access your funds easily without much friction. Overall, traditional investments offer a liquid, low-friction, and diversified option that suits investors who prefer a hands-off approach and require flexibility without compromising accessibility. Here, we're focusing on a hybrid allocation strategy designed around balance rather than putting all our eggs in one basket. This approach spreads investments across different asset types to achieve growth, income, and liquidity in a complementary way. First, real estate makes up 40% of the portfolio. This component offers income generation, leverage opportunities, and protection against inflation, making it a crucial pillar for steady returns. Next, bonds and stocks comprise 45%. This allocation provides diversification and taps into market growth potential, while also allowing for easier portfolio rebalancing over time as market conditions change. Finally, we hold 15% in cash reserves. This portion ensures liquidity, so the portfolio can handle unexpected shocks, vacancies in properties, or seize new investment opportunities without needing to sell assets at unfavorable times. The key is this deliberate distribution of different risks, owning varied risk types on purpose, to create a more resilient and balanced portfolio overall. Altogether, these segments add up to a full 100%, optimizing both stability and growth potential. Let's review the key takeaways from our discussion. First, real estate rewards patience and control. It's not a quick flip game. Success comes from holding properties over time and managing them carefully. Second, portfolios perform best when they focus on liquidity and simplicity. Having assets that are easy to buy and sell and keeping the strategy straightforward can really improve outcomes. Third, leverage should be a powerful tool, but it's important to remember that it amplifies both gains and mistakes. Using debt wisely is crucial. Finally, the best investment strategy ultimately depends on your personal goals, risk tolerance, and circumstances. There's no one size fits all approach. So it's essential to find a route that works best for you. Now that we've covered everything, it's time to focus on the next steps. The key question is, which path aligns best with your current goals? When making this decision, it's important to prioritize factors like your timeline, liquidity needs, and level of involvement over any market hype. Whether you're looking at real estate options or portfolio investments, matching the right vehicle to your overall plan is crucial. Consider whether you want a guided approach or more open involvement. Reflecting on your status and objectives will help you proceed confidently. This thoughtful decision making ensures your next move supports your long term success.